Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm very happy to be providing this week's topic, which is Generate Income with Covered Calls. Options uniquely allow you to enhance your returns by combining long and short positions so that you can generate income on a steady basis. Many investors generate significant returns through these income strategies by selling option premium on a monthly basis. Now, the covered call is the most basic of option income strategies, yet it's also highly effective and can be employed by option newcomers and experts alike. What I would like to do in this presentation is walk through the important aspects of the covered call. My goal is to illustrate the power of this basic income strategy and lay a foundation that allows you to generate safe, steady income for your retirement portfolio. So let's start with the description or definition of the covered call. And it has two parts. The first is the simultaneous purchase of an underlying equity and the sale of a call of the same security. When you do them simultaneously, they are also referred to as a buy right, where you're buying the underlying stock and selling a call option or writing the contract. They are synonymous. And of course, you can also sell one option against every 100 shares of stock that you already own. One of the most straightforward definitions of a covered call that I like to use is from a book by a gentleman named Lee Lowell called Get Rich with Options. And he writes, if you own shares of stock and you're not selling calls against them, you're throwing away free money. He says there are traders out there who will give you money today for the right to take away your stock from you if it reaches a much higher price. He goes on to say selling covered calls is such a great strategy for padding your bank account that I still can't believe there are investors who aren't taking advantage of it. My purpose in this presentation is to get you to take advantage of it. Let's first go over a couple of basic definitions and terminology on call options. So we know there are two types of options. There are call options and put options. And you can buy a call or a put, and you can sell a call or a put. This is the foundation from the most basic option strategy to the most complex strategy. In this presentation, we're not going to be talking about put options, and so we'll cross those out. What we're going to focus on is the seller of a call option. First, let's start here in the upper right corner. If you're the buyer of a call option, the buyer of a call option pays a debit for the right to buy 100 shares of a stock at a certain price by a certain date. Remember, an option is a security. It trades just like a stock with a bid and an ask price. There are market makers who are tasked with providing a fair and orderly market. And it's also a contract with strictly defined terms and conditions. And those terms and conditions are that certain price by a certain date. Now that's on the buy side. On the sell side, the seller of a call option has the obligation to sell or provide 100 shares of a stock at that certain price by a certain date. Remember, the seller gets paid, but he doesn't get paid for nothing. He takes on obligations. Let's take a look at what a short call or selling what's called a naked call looks like on a P&L profile. This does not include owning the underlying stock. This is if you just sell a call option. On the x-axis is the value of the underlying stock. We can see that as that value rises, loss grows, and in fact, that risk is unlimited. So while selling naked calls may be fine for the more advanced trader, for our purposes, the short call or selling a call is best used in combination with another trade to limit risk. And in this case, that trade is the covered call. So let's take a look at the risk-reward profile of the covered call. Now, the first thing we notice is that our max profit is capped. Our max gain is capped at a certain level. And you'll often hear that one of the disadvantages of selling covered calls is that the upside is always limited. So why cap your profit potential? Now, have I left gains on the table because of a covered call? Without a doubt. But you have to remember that could happen on any stock that you have sold and then continued to go up. So we can always look back and say, darn, I should have held that stock. But as I'll talk about in a moment, it's all about your objective. Now, the next important facet here is that we have to know the break even, or what's also known as the cost basis, which is always going to be the stock price minus the premium that I received. That's the cost basis of that overall position. And then finally, the max risk. The risk comes from owning the underlying stock. That's where the risk comes from, not by selling the covered call. So like any trade, knowing your max profit, your max risk, and your break even is important before you hit the enter button. Now just two more quick definitions before we get into the core of the trade here. Assignment. You're going to hear me use the word assigned or assignment. It means to be required to meet the obligation of your contract. If you are the seller, you are assigned and are obligated to supply the stock. Now, the other important term is exercise. That means to invoke the right contained in your option contract. If you are the buyer, you exercise your right to buy the stock. So think of it this way. If you're assigned, it happens to you. And if you exercise your right, you made that happen. I want to take a moment and build a theoretical trade here to take a look at the anatomy of what a covered call really is. And then we'll look at some what-if scenarios. So we go out and we buy 100 shares of XYZ at $60 per share. At the same time, I sell one XYZ 45-day call option, that's 45 days to expiration, with a strike price of $62.50. And for that option, I receive $2 per share, or $200 for the option contract. That leaves me with a cost basis of $58 per share. So in other words, someone out there paid me $2 per share to take my stock away at $62.50 per share. Now we'll take a look at some what ifs. At expiration, what if XYZ is above $62.50? Well, remember the cost basis is $58 per share. That would leave a profit of $4.50 or 7.5% return on investment in just 45 days. That's the ideal result. If XYZ is below $62.50 at expiration, remember I'm long the stock at a cost basis of 58. We took in a 3.3% initial cash yield, which lowered our cost basis, or as we say, built a cushion, so the stock could even go down a little bit or stay where it is, and we would still make money on the covered call. Finally, if XYZ falls below 58 at expiration, losses will occur, but we'll talk about risk management in just a little bit. So now that we've defined the covered call trade, let's get to the steps taken to enter the covered call. And it has to do with both the underlying stock and the overall market trend. So keep in mind that the market bias for the buy right is bullish. The risk involved in selling covered calls comes from owning the stock, not from selling the call. The market bias for selling a call against a stock you already own can be considered neutral or defensive, as it allows you to profit if the stock does not move and reduces the loss if it does go down. So that's our overall market view and the view on the underlying stock. Now next is the objective of the trade. And like any trade, before you hit the enter button, you have to know what your goals are, what your objective of doing the trade is. And as we will see, we know what the max profit is when we enter the trade. So capturing that, or at least a good percentage of that, means that the trade was successful. Remember, you made a conscious decision that you were willing to sell your stock at that strike price. And if you're assigned, you achieve that objective, and it means you did good. So here are the objectives of the covered call. First and foremost is to generate cash income. It also helps to reduce the cost of a long position, enhances the total return, and then again, as that defensive or neutral measure, it allows you to reduce downside risks of long positions. Next, of course, is the trade setup. How do we set this trade up? Well, there are several steps to that, and first and foremost is going to be market direction. But once we have found our bias on the overall market direction, the next important step is finding the right stock. We then need to have the proper expiration date and strike price. Remember, those strictly defined terms and conditions. You set up your trade, you have to be sure to pick the proper expiration date and strike price. And then we have to make sure that that credit received is favorable. In other words, is it worth putting this trade on to begin with? Let's go into the VectorVest program and start with that market bias. So the first thing that I do before I place any covered call trade is come to the VectorVest homepage and be sure that the market is favorable. Remember, if I'm doing the buy right, which is what I'm going to focus on right now, I need a bullish sentiment on the market. Now, if we look at today's market, it is a mixed market. The Dow and the S&P are up slightly. The NASDAQ is down slightly. All of our indicators are up. I would like to see a green light in the price column. That'll come if the VectorVest composite can go up just about 4 cents from where it is now. But for our purposes, I'm going to assume the bullish bias here. And again, with all of the indicators up and a whole string of green lights there, I'm okay with the current market condition. So once I have determined my overall market view, the next thing I'll do in the program is go to the Unisearch tool. I come down in the search directory to the retirement folder. And this is just one of many searches that you can use to find good quality underlying stocks and then be sure that they're the proper option candidate, of course. For this example, I'm going to scroll down to one of my favorite searches, the Premier Growth Stock searches. You can see I already have it up here. Another great one is Ruler Stocks, and there are countless others, but for our purposes, I'm going to use Premier Growth Stocks. I'm going to break that down so we have a little more room to look at these stocks. And the stocks that come back to the top of the list are stocks that are sorted by the VST times relative timing times the comfort index. And they have an earnings growth rate of at least 14% per year, and they are larger cap stocks. Now, what I've done is I've put a price parameter on here to bring back stocks that are less than $100 per share. Because if I delete that parameter and I click and bring back the top 10 stocks here, you'll see Tesla is at the top. It's a $1,650 stock. It's quite a capital outlay to go buy just even 100 shares of that stock to sell a covered call against. There are other option income trades that might be used for that, but for our purposes, a stock like AMD is what I want to look for. So we see some other high-priced stocks. So the way to eliminate that and to get stocks that only come onto the list based on a certain price parameter is to go into the parameter box, and I'm going to add a price parameter, which is called price actual. I'm going to choose less than or equal to for the operator, and you can choose the price. It can be $100, it could be $60, it could be $300, whatever you want to place there. For our purposes, I'm going to put $100. So when I run the search now, any and all stocks will be priced less than 100, which brings AMD to the top of the list. Some great stocks at the top of this list here. I'm going to go ahead and take my next step, which is finding the proper expiration and strike price now to be sure that AMD is a good option candidate. What I'm going to do here is right-click on AMD, and I'm going to use the VectorVest Options Pro software. And within that software, I'm going to bring up an option chain, which is very similar to any of the mainstream brokers that you probably are using. So I can adjust my expiration dates, and I can take a look on the left are calls, on the right are puts. I have my strike price, my bid-ask price, and all the information I need. Again, this is the same or very similar to what any mainstream broker would look like. So I'm looking at AMD. And I have to first choose the proper expiration date. The sweet spot, or the window that we like to use, is an industry standard 30 to 45 days to expiration. Sometimes you can go slightly shorter than that, you can go a little bit longer, but somewhere in that range over time will find you the best premiums and be part of the most successful trade setups over time. So my expiration date in this case is the monthly expiration 35 days out. My next step is to find the proper strike price. Generally, we're going to be selling either 1 or 2 strikes out of the money. So with AMD trading at 81 1/4, the $80 strike would be considered in the money. The 82.50 would be slightly out of the money, and then there's the 85 strike. These are the two I would focus on. If I choose the 82.50, I take an extra $1 of premium in by selling a covered call against it. But what I give up by doing that is capital appreciation potential. Remember, if the stock goes above 82.50, they're going to call it away, which will leave me with about $1.85 or so profit on top of the $4.55 that I would take in. I could go to the 85 and take in also a nice premium of $3.60 if I'm more bullish on AMD. So these are the considerations you have to take into account. I'm going to go ahead and choose the 82.50 and go ahead and take in that higher premium. At least $4.55 is what we would take in based on this trade. Again, in the Options Pro software, I can model this trade, and for illustrative purposes, that's what I want to do here. So I'm going to choose covered call, and I can edit this spread by making sure I'm going to buy 100 shares. I'm selling one September 82.50 strike. Okay, that's the trade I want to set up. Now, Within the Options Pro, just like most mainstream brokers, is what's called the risk graph. Okay, we can create or model this trade on a risk graph. And these are very helpful because it lays out all of the important numbers we need to know. So let's make sure we're set up correctly. We're buying 100 shares, we're selling one contract. Now, just so these numbers will stop blinking, I can go in and set up the theoretical fill price. I'm going to use 81.20 and $4.65 premium that we receive. Now, once I do that, my risk graph over on the right will now tell me what my break even is, or my cost basis. So AMD can go down to 76.55 before I begin to lose any money. I know my max risk, of course, theoretically is the stock going to zero, and my max profit is $595. Now that max profit is a nice 7.7% return on my investment if the option were called away or assigned. So to recap, we stayed in the 30 to 45 day window by choosing an option with 34 days to expiration. We sold one strike out of the money, and the premium received, again, I mentioned the favorable credit that we receive. What we want to be able to see is at least 2% of the price of the underlying stock, which this particular premium meets and then some. So that's a nice premium to take in on an $81 stock. And that's how we model the buy right. Then finally, we need to talk about trade management. We have to have a specific plan or a process to capture both profits and mitigate losses and know when to exit a trade when it goes against us. So to the upside, of course, it's great to capture the max profit. But for our retirement income portfolio that we use in our retirement coaching group, we look to capture at least 80% of that max profit. Because as it gets closer to expiration, we don't want to take the risk of giving back the nice profit that we had for an extra $100 or $200 for the position. So we don't generally hold these to expiration. We'll take that 80% of the max profit once it's there. Now on the downside, what we'll do is just simply flip the $595 and say that's what I'm willing to lose on this trade. That's the number we've identified in our trading system to say that's what I'm willing to lose. Let me just show you what that looks like. Now I have a spreadsheet here, which is nothing more than a journal that we keep, that I like to keep. It also helps me to identify my action levels on both the gain and loss side. But really it's just a way of tracking my trades and keeping a good quality risk management technique in place. And for an example, I'm going to use an AMD trade that we did earlier this year. We've actually traded this stock round trip 3 times already this year, all profitable trades. And we currently have an AMD trade that's open for our buy right portfolio, what we call the retirement income portfolio. So here was the scenario. We bought 200 shares of AMD at $49.07. We sold 2 contracts at $265 per share, and we brought in $530 for our initial cash yield. That left us with a break-even price of $46.42. With a max profit of $716, that includes capital appreciation and the premium received, we would calculate that our profit target is 80% of that max profit. We simply use the aggregate price, which means buying back the call and selling the stock. That's the aggregate price of this position because we're doing it simultaneously. Would mean that with a cost basis of $46.42, we would look to get out at $49.28. Now the downside, as I noted earlier, is simply the flip side of our max profit. In this case, the aggregate price would be $42.84, and that would be a 7.71% loss were we to be stopped out to the downside. Now using this calculation, I've found that it leaves a reasonable stop criteria, usually around 10, usually less than 10, sometimes significantly less than 10%. Now the great thing is, as I scroll over, this year we've done 18 round-trip buy-right trades in our retirement income portfolio. 3 of those were AMD, and the 4th actually is still open. You can see our profit and loss. We've done 18 round-trip trades. We have 15 winning trades, and these 3 trades that are open currently are all profitable, but they're still open, unrealized gains. And of course, not every trade is successful. We've had a couple of losing trades as well. The purpose of sharing this spreadsheet with you is to understand that with the proper risk management techniques, with the proper process, of finding the right underlying stock, having your trade aligned with the overall market trend is a great way to generate income using covered calls. And I'll just note that from mid to late February, right up until April, of course, when the market was selling off, we really didn't do any trades, and we didn't start doing these trades again back until early April. And again, we've been on a nice run since then. And that's how you can generate income using covered calls. Generating income with covered calls is just one part of the 3 core strategies that make up our ultimate retirement solution. Coupled with understanding how to build and manage a capital appreciation portfolio, a dividend growth portfolio, and most importantly, understanding how to preserve your capital with strategic defense trades like protective puts and collars. These are the 3 core strategies that every retirement-minded investor must know so that they can retire with a peace of mind, knowing they can grow their portfolio, knowing they can generate a safe, steady income, and knowing that you can protect your portfolio when the market moves against you. If you're interested in learning more about the 3 core strategies to protect and grow your retirement nest egg, please join me next Wednesday and Thursday. I'll be conducting a webcast. You can go to www.vectorvest.com/webURS to sign up for this free webcast. That link will bring you to this page. You can choose your date and time that you'd like to join me. I'll be doing this again next Wednesday and Thursday. In the meantime, please stay healthy, stay safe, and I thank you for taking the time.